Testifiers who are seated, and we've got the commissioners that are back. We've got our stenographer here. We're ready to get started again. I apologize. I'm going to apologize again because I may want to move you along a little bit. There's some people that will be standing by, and we will try and move this along quickly. We'll keep our questions brief, please, commissioners, and I'll try to be mindful to give you enough time to testify, but we'll try and keep it moving along. So we have Craig Lazzara, Managing Director and Global Head of Index Investment Strategy, and ASO, Managing Director, Global Research and Design Standards, and Design of Standard & Poor's Dow Jones Indices. So thank you very much. We appreciate your being here and your testimony today. Thank you.
Mr. Chairman, members of the Commission, thank you very much. We're delighted to be here. What we thought we would discuss is a topic that's near and dear to both our hearts, and we call it the growth of passive. So what is happening and why? And before we get into the formal presentation, sometimes when we make an analogy to the growth of passive, there's a quotation from Hemingway. In one of Hemingway's books, one of the characters goes bankrupt. And one of his friends said, what happened? How did you happen to go bankrupt? And he says, well, there are two ways, gradually and then suddenly. And that's how passive has grown, gradually at first and then suddenly. Next slide, please. We put a quotation here at the beginning. We would like to set the stage with a notion, a sentiment from Charlie Ellis, who said that active investing has been subjected to increasing abuse, particularly by those whose opinions are driven by the persistent accumulation of hard data and logical arguments. And sometimes when I read that, I say, who would stoop to that? But that's what we're going to aim to do. Next, please. And it's important to keep in mind that what we talk about, the growth of passive, what we're talking about happened within the past 50 years, in the lifetime of at least some of us who are here today. First institutional index fund was launched in 1971. The first, which was not an S&P 500 tracker, but soon became one. The first mutual fund that tracked the S&P 500 was barely launched by Vanguard in 1976. ETF followed in 1993. Passive assets, as I've alluded, were negligible for many years. Today, depending on how you count and what you count, between 20 to 30% of U.S. equity capitalization is held in passive portfolios. So the question is, why has that happened, please? And we're going to talk about really three headings. One is just evidence. What did people look at when they were making decisions to move from active to passive? Secondly, explanations. Why did the evidence come out the way it did? And finally, if time permits, I'll address some of the controversies that have arisen as a result of the growth of passive. So starting with the evidence, going 2 slides, please. My colleague A is going to present some of the work that we have done for the past 18 years on measuring active versus passive performance. But I want to make it clear that this did not start with us as an index provider. The earliest study of active-passive performance that I'm aware of goes back to 1932. And I put 2 quotations in the presentation, one, again, from Charlie Ellis, from the mid-1970s, demonstrating that even that long ago, there was lots of evidence that the average active manager was underperforming the average the market index. Paul Samuelson, Nobel laureate, wrote a famous article in 1974 in which somewhat bitingly concluded that the world would be better off if most portfolio decision makers stopped what they were doing and did something useful like become plumbers or teach Greek or something like that. So it's those of us who know Samuelson only from his economics textbooks would not have suspected that he had a sense of humor, but in fact he did. We have taken up that torch, if you will, and my colleague A.So. has led that effort for the past dozen or so years. So let me ask her to present some of the work that we've done on documenting the active versus passive phenomenon.
Sure. The next slide, please. And again, thanks for having us here. This is a great opportunity for us, and we're very happy to be speaking on our research. Could we move to the next slide? Yes. So as Craig mentioned, the next slide, yeah. So, passive has been in investors' asset allocation process for a long time. But when we really start to see the attention and the interest and the explosive growth is really in the aftermath of 2008 financial crisis. And that is leading us to where what I believe, or we believe, is this structural shift in the asset management industry. And floodgates are open, and it sees no signs of stopping or the trends reversing. So if we look at the flows and the chart in front of you, you really see that passive has always had a place in investors' portfolio. But it's only in the wake of 2008 financial crisis, you really see this divergence in trends. You see the flows into passive funds going up one direction, and the flows into active funds going down in one direction. So what gives? What happened in the wake of 2008 financial crisis? Well, there's a few trends that happened concurrently, but we will touch upon the single most important part. That is, in the wake of 2008 financial crisis, investors, whether it's institutional, retail, mom and pop, high net worth, they woke up and they realized that, my goodness, the manager that I've been paying fees failed to provide downside protection. But if we go back and retrace our steps and go back to history, because we've been publishing what we call the Spiva scorecard since 2002, so we have live track record of the past two bubbles, you will see that by and large, managers, particularly in the equity space, have been underperforming the respective benchmarks. So the next slide, please. So this is the Spiva scorecard that we produce around the world in 9 different countries and regions. But what we will focus on is the data and the analysis that we're doing in the US. The next slide, please. So what we're seeing in front of us, these are institutional equity managers. And to be fair, we're using gross of fees because we understand that institutional plans like yourself as owners can have favorable agreement with managers. So we're using gross of fees returns. And these are the institutional equity funds. You will see that over the last 10 years, even when measured on the gross of fees basis, the majority of actively managed equity funds underperform their respective benchmarks. We actually have data going back 15 years, and trust me, it's no different. So moving on to the next slide. So now fixed income. We do see a little bit of mixed results in fixed income. Again, fixed income as an asset class is not like equities, it's complex. There is an opaque pricing structure, and there are some structural inefficiencies, so we give that credit. However, you can still see that only a handful of fixed income managers beat the benchmark in 2 categories, even after using gross of fees returns. So what we can conclude from these 2 slides is that managers, by and large, struggle to beat the benchmark over the long-term investment horizon. We might see in 1 year, based on market conditions, managers doing better. But again, as we heard from the Stanford professor this morning, 1 year is noisy. We like to look at it over 3, 5, 10, and preferably over 15 years to establish the trend and to find patterns. And I don't have it in front of me, but this morning there was a question that was asked on risk-adjusted performance, because risk and returns are 2 sides of the same coin. I couldn't agree with you more. And we have published a study looking at risk-adjusted performance of actively managed equity and fixed income funds. And because we believe that you should be compensated for the risk that you take. And if you're taking compensated bets, it should show up in your results. And what we find is that even after using risk-adjusted performance figures, managers by and large struggle to beat the benchmarks. So next is the other topic that we've focused quite a lot of our time on. Next slide, yes, which is the persistence. Performance persistence is very much studied in literature. There's a lot, and the literature has always said there is a lack of performance persistence. So we have been producing what we call the persistence scorecard. And the way to look at it is, in any given year, we're looking at what is the likelihood of this top quartile manager, consistently staying in that top quartile. And what we find is that by and large, right, they fail to, the probability of your top quartile manager being in the top quartile by the end of 3-year period is less than the probability of a random coin toss. So it's very, very small. And that tells us that we shouldn't chase performance because your given top quartile manager in a given year may not be in the top quartile by the end of the third year. And if you extend the horizon, because we've done so much research in this space and it's so fascinating, the longer is your investment horizon, the smaller is your performance persistence. So by the end of 5 years, what we typically find is that there's zero performance persistence, or zero funds that remain in the top quartile. Moving on to the next slide. Now we will focus on the fixed income funds, performance persistence of fixed income funds. We see slightly better performance persistent figures with fixed income funds. But again, is nothing that is what we will call substantial or significant. It's just a slightly better than your average equity active manager. So the figures are slightly better. But again, if you extend the investment horizon, that figure also declines as well. The next slide. So this is based on the study that we published last year, which we call Fleeting Alpha. And one of the motivations of our study is we always get this, Craig and I, I have my manager, and my manager is Warren Buffett, and he, or something akin to that, and he's going to beat the benchmark every year. You just haven't found the right manager, but I found mine. So that inspired us to take on this study. Okay, let's take a look at a manager in a given quarter. Based on his past 3 years' performance, let's take a manager, let's track that group of managers that managed to beat the benchmark in that quarter. And let's do that every quarter, and let's repeat the exercise for 15 years. And what is the average persistence rate? So the way to look at it is, in a given year, about 27% of domestic funds managers beat the benchmark. However, come the next year, out of that 26 or 27%, only 30% will go on and beat the benchmark. And after that, in year 2, it declines to 10. In year 3, it declines to 3.7%. So what we are really seeing is the decline or the decay in the performance persistence of your so-called Warren Buffetts of the world. And last but not the least, we want to touch upon fees, because we hear so much about fees, right? The reason I'm underperforming is because I'm charging you fees. So we really want to understand, do fees contribute meaningfully to a manager's underperformance? To do that, we looked at all the institutional asset managers and the institutional accounts, right, separately managed accounts. We compare the performance on gross of fees basis and then also net of fees basis. And we look at it for equity managers as well as for fixed income managers. And what we find is that in equity, when you add the fees back, your manager's underperformance improves, but it's not enough to move the dial or change the conversation. For example, your underperformance in large cap will go from 80% underperforming to 70% underperforming. So you get about 10% improvement. But it's not enough to change the conclusion. We picked fixed income because sometimes fixed income is interesting. It's a fascinating asset class to study. When we add fees back, we do find that some fixed income managers do end up drawing parity with the benchmark or end up outperforming the benchmark. So that tells us a lot, that in fixed income, returns are very tightly clustered, right? So the opportunity to beat the benchmark is very little, but that alpha gets eaten up by the fees. So that is the conclusion that we've reached. We've published a lot of studies, written a numerous number of papers on that. And with that, I'm going to turn it back to Craig for the explanations.
Thanks, A. If I had to summarize the burden of many years of A's research, I'd say there are really two conclusions. One is that the average active manager underperforms most of the time. And secondly, that even if you find one who's been successful, either relative to a peer group or relative to a benchmark, historical success has no predictive value in predicting future success. Now, this in a sense, cries out for an explanation because active managers are smart people. They work hard. They've gone to good schools and gone through a lot of training programs, and they certainly have tremendous financial incentives to be successful. So why do so many of them fail? And we've suggested 2 slides. There you go. 4 reasons, which we'll try to discuss quickly: cost, the increased professionalization of the investment management industry, the skewness of returns, which is something not well appreciated, and finally, the level of innovation that we see in the indexing business. So let me take cost first, and I have not much to add to what Professor Monk said this morning. The slide in front of you simply tracks our estimate of the amount of assets, or the assets under management, that are tracking the S&P 500, explicitly tracking the S&P 500. As of the end of last year, our estimate about $3.4 trillion. The reason I show you that is to try to get some quantification around the magnitude of cost savings. In the U.S., roughly there's a 70 basis points difference between the average fee charged by active managers versus the average fee charged by passive managers. 70 basis points times $3.4 trillion is about $24 billion a year. So 24, and that by the way it counts only the S&P 500, not our other indices, not our competitors' indices. So if $24 billion a year is being saved by investors who are using passive trackers and not actively managed portfolios, you might expect the active management community to push back, and they have, in fact, and we'll discuss some of that in a little while. Second, next please. The second reason that active managers find it difficult, other than cost, is that there's no natural source of alpha. I use the word alpha kind of loosely in this case. I mean, outperformance. There's no natural source of outperformance. What I mean by that is if we are in this room, all the investors in the U.S. stock market, if I'm going to be above average, one of you has to be below average. There's no source of my outperformance other than someone else's underperformance. If the commission on this side of the table are all above average, the weighted average sum of their outperformance is exactly matched by the weighted average underperformance of all the losers on the other side of the room. There's no natural source of alpha. Now, the reason that's particularly important is because when assets shift from active to passive, arguably it is the least capable active managers who lose the most assets, and that makes the active management game harder yet in kind of a ratcheting mechanism. Next slide. And to illustrate that, we have a very simple example here. We've posited 2 scenarios, say that a market of $20 trillion. In scenario A, all of it is actively managed, so $20 trillion actively managed, $10 trillion above average, $10 trillion below average. If you want to know what the supply of alpha is in scenario A, you have to ask the question, how much do the losers underperform by? So I've made an assumption, say it's 5% on average. 5% times $10 trillion is $500 billion. So in scenario A, $500 billion is the amount of outperformance divided up among the winners. Scenario B, we change 2 things. First of all, we provide a passive alternative, so only 90% is actively managed, 18 trillion actively managed, 9 trillion above average, 9 trillion below average, and 2 trillion takes the average and goes home happy with low fees. The question now is, what is the performance of the underperformers now? And the argument I want to make is, whatever it is, it's not as bad as 5%, because presumably it is the least capable active managers who lost assets to passive. So we assumed in this case 4%, it could be anything. 4% times 9 trillion is 360 billion. So simple and simplistic example to show you how a 10% reduction in active assets leads to a 28% reduction in outperformance. And it goes on and on from there. The existence of passive makes it harder for the active managers who remain. Another way to say that, and we'll come back to this perhaps later, it's kind of a crude analogy, but you think of, the lion will catch the slowest zebra in the herd. After the lion catches the slowest zebra, the average speed of the herd goes up. The bar gets lifted, and that's what's happening with active managers. Next slide, please. I mentioned the notion of skewness earlier. It's kind of a jargon statistical term. It's something that helps explain why active management is so difficult. It's not terribly well appreciated, so I want to take just a moment to tell you about it. You know what a bell curve looks like, right? So normal distribution. Stock returns aren't like that. A stock can only go down 100%. It can go up 100, 200, 300. So there's a natural, it's called positive skewness or right skewness built into stock return distributions, and a simple definition of skewness is that the average return of a distribution is greater than the median. That's because there's some big outliers that are driving the average up. And so you can ask empirically, how often in the U.S., for example, is the average above the median? The answer is for the S&P 500, the last 27 years, 23 of them, the returns have been skewed to the right. It's very similar in other, this is not an American phenomenon. We looked at Canada, Europe, Asia, they're all in the same kind of ballpark. Next slide, please. When you go back over longer periods of time, the result is even more distinct. This is a look at the last 20 years of returns for the S&P 500. The median stock, the one in the middle, over 20 years was up 50%. The average was up 228. The one all the way out on the right, by the way, people always ask, that's Apple. But the average is much greater than the median. Now, next, please. What that means is there are a number of consequences of that kind of distribution. One is the obvious one for today's purpose. It obviously handicaps active managers. If you're selecting stocks with no skill, half the stocks you pick will be above median. But in this kind of distribution, well under half will be above average. So there's an automatic handicap that active managers have. A secondary thing, like we didn't mention it here particularly, but it came up this morning in the discussion of venture capital. This helps explain why equally weighted indices typically do a lot better than capitalization-weighted indices. There's more likelihood in an equal-weighted index of having a big position in one of the stocks that does extremely well. A secondary consequence of skewness, as we've said here, is that the probability of outperformance rises when portfolios are more diversified, not when they are more concentrated, which is exactly the opposite of what most active managers believe, by the way. And that suggests a possible equilibrium between active and passive. If time permits, we'll go into that at the very end. Next, please. The final reason that passive has grown has to do with what I sometimes call index evolution or index innovation. Indexing, even as young as it is in 50 years, has gone through a number of generations. In the beginning were what I would call broad market indices, S&P 500, Russell 1000, MSCI EAFE, designed to represent an asset class, typically capitalization weighted. There was a second generation, I call them here specialized, which we think of as subdivisions of the first generation or extensions down the cap scale. So S&P 500 large cap index begets S&P 400 mid cap, S&P 600 small cap, and then, of course, divisions into sectors and industries and so forth. Final generation is what the world typically calls smart beta. I like to refer to it as factor indexing, a completely different approach. What factor indices try to do is to give you, as an investor, exposure to a pattern of return or a characteristic with which excess returns are thought to be associated. Fama in French, for example, said many years ago that cheap valuation and small size are factors of return. So you can obtain those factors via an index fund. You don't have to hire an active manager to get them. And that's the sense in which we said here, factor indices let you indicize active strategies and therefore create more competition for active managers. Next, please. One example, we could talk for hours about this one, the S&P 500 Low Volatility Index. This is the 100 least volatile stocks in the S&P 500, rebalanced every quarter. You can see over time it's done much better than the S&P 500. This is in the academic literature sometimes called the low volatility anomaly. And again, I'll skip over it now. There's a long explanation of why this thing exists. Next, please. But if you look at the patterns of return, what you see here is that low volatility indices, and others as well, but this one particularly, tend to underperform if the market's up a lot, but they outperform when the market's down. So they give you protection in down markets, participation in up markets. Now, this index developed in 2011, so it's a little more than 8 years old now. 7 years old. We did not invent defensive equity indexing when this index came out, but because of indices like this, you can now, as investors, indicize patterns of return that you formerly would have had to pay active fees to get. So there are great opportunities for cost savings and also increased competition for active managers, helping fuel the rise of passive. So those are four main reasons, in our view, why passive has grown to the point it has and continues to do so. Now, the final things I want to cover relate to the notion of I call it controversy. Active managers challenge it to indexing, and there are a number of these that are out there. We've tried to list here four of the more common and I think more respectable ones. But remember what I said earlier: if $24 billion is being retained by investors and not paid to active managers every year, you might expect them to resent it and try to muster arguments why this is a bad idea. And these are some of the ones they've mustered. So we'll talk about all of them relatively quickly: common ownership, stewardship, bubbles, and market efficiency. So common ownership, the complaint here that active managers raise next is that because large indexers, the three big indexers, Vanguard, State Street, BlackRock, own maybe 20% roughly of every company in the United States, certainly everyone on the S&P 500. The suggestion is that because these companies have common owners, they are not incented to compete against each other as vigorously as they would otherwise do, and therefore there's diminished competition and higher prices. Our response to that is that there are some data that support this thesis, but there's no causal mechanism that's ever been identified. In other words, the most important study here is one that deals with airline prices in the years 2000 to 2014. True, ticket prices might have increased in those years, and indexing certainly was bigger in those years, but there's no causal link between the two. So this is something that some economists believe, some do not. Our contribution is simply to say, particularly with the airline ticket example, airlines are 0.5% of the S&P 500. Even if the big three could do it, why would they increase the revenue of 0.5% of their holding and increase the cost of the other 99.5%? Somehow doesn't make sense, but that's the first argument. Second is around the issue of stewardship. Again, coming back to the big three, for example, index funds are substantial owners of more or less every company in the U.S. and many foreign ones as well. The complaint is that index funds have no incentive to engage with corporate management on governance issues. And in response to that, we'd say it's actually just the opposite. Index funds, in a sense, are permanent capital. If they don't like what the management is doing, they don't have the opportunity to sell, as an active manager would do. So index funds and indexers have a greater incentive to engage with corporate management, not a lesser incentive. And the reason this is important is that the index funds themselves may be locked. If you're an S&P 500 index fund, you hold all 500 stocks. You're locked into your investments, but your investors are not locked into you. If the investors find that there's a way to improve their returns by shifting to an active manager, they have the option of doing it, which gives index funds the incentive to try to improve the performance of their portfolio companies. The big three, by the way, in this regard, have all been very vocal, have staffed up, enlarged their corporate governance staffs, and have been quite vocal about the importance of governance to their investment process. Third issue relates to, I called it here bubbles. The complaint is that flows into index funds cause distortions in the pricing of index constituents, and that the money flowing into funds makes it hard for active managers to compete. And we've all heard complaints that say, well, of course, because of the money going into passive, it's really hard for active managers to take place. A couple responses. One is that index flows themselves do not cause distortions in relative valuation. I can show you this with a simple example. Apple, for example, is 4% of the S&P 500. Let's suppose you were to allocate $10 billion to an S&P 500 index fund to be invested between now and the close, which I suppose is actually possible. You would buy, Apple is 4% of the S&P 500 now. It's going to be 4% of your buy program, and when you're finished, it's still going to be 4% of the S&P 500. There's been no movement in relative valuation because of this putative flow. Apple could be overvalued. That's not the issue. It could be grossly overvalued. But it didn't get to be overvalued if it is because it flows into index funds. It got to be overvalued because it flows into the stock itself. The second response we'd make relates to the whole notion of, do index funds accentuate momentum? There may be a momentum effect as underperforming active managers are fired and replaced either with outperforming active managers or index funds, but the effect occurs because institutions generally and individuals generally tend to fire underperforming managers. Underperforming managers, by definition, own stocks with low momentum. Outperformers own stocks with high momentum. So this dynamic of the replacement of low momentum with high momentum occurs regardless of the status of indexing. And indexing actually reduces its importance because index funds are typically much more diversified than the active portfolios they replace. So I think the bubble argument is not a particularly strong one. Finally, and then this is really the most serious, I think, of all complaint. Index funds do not contribute to market efficiency, the active managers say. The backdrop of this notion is that market efficiency comes about because we have lots of managers looking for valuation disparities and trying to drive market price toward fair value. So if I have a view of a stock that is overvalued, A thinks it's undervalued, I might sell it to her. That's a process we call price formation. Index funds don't do that. They're what in the jargon is called price takers. They simply buy what's in the index at whatever price they have to pay for it. And therefore, the argument is market efficiency is reduced. Again, a couple responses or several responses to make to that. First of all, factor indices, as we discussed, are not price takers. Value-tilted factor indices buy stocks because they're cheap. Low volatility indices buy stocks because they have low volatility. They follow, in other words, some of the same kinds of disciplines that active managers follow, granted on a different time scale and different metrics, but they do contribute to price formation in that sense. Secondly, index trading at an aggregate level, the most actively traded securities in the U.S. are ETFs that track the S&P 500. So aggregate price formation is driven in large part by trading in index vehicles, and then through the arbitrage mechanism, this trickles down to the microeconomic level. Thirdly, we talked earlier about the lion and the zebras. The growth of passive raises the quality of the surviving active managers. The better the active managers are, the more efficient the market will be. And finally, market efficiency in this paradigm depends on trading, not assets under management per se. And what we put on the next slide is an illustration of that. The assumptions behind this slide are that the average active manager's turnover is about 50% per year. The average index manager's turnover is about 10% per year. Those assumptions are quite conservative, I think, in both directions. The ratio is actually much greater than that. But what this shows you is that if indexing amounts to about 20% of assets under management, active managers do 95% of the trading. If index management rises to 50% of all assets under management, active managers will still do something like 80% of all trading. Jack Bogle, the founder of Vanguard, said 6 or so months ago that he thought indexing could easily get to 70 or 80% of the U.S. market without any loss of market efficiency. And these are the kind of data that support that view. You have a very long runway for index funds before there's any impact on market efficiency at all. Final thing to share with you it comes back to the notion of skewness. And I want to illustrate an important consequence of skewness, which also gives us a way to think about how active and passive may finally settle into some kind of equilibrium. So what we're looking at here is a very simple example. We have a market of 5 stocks. 4 of them go up 10%, 1 of them goes up 50%. They're all the same size, equal weighted market. The average return of these stocks is 18%. Now, what we're going to do next is to form portfolios out of these 5 stocks. We can form 1-stock portfolios, 2-stock portfolios, 3-stock, 4-stock portfolios. And the results are shown here. There are 5 possible 1-stock portfolios. 4 of them underperform. There are 5 possible 4-stock portfolios. 4 of them outperform. You'll note, and the 2 and 3 cases fall in between. You'll notice in all cases the average return is 18%. If the market gave you 18, it doesn't matter how you slice it up, you get 18. But the average return is 18. But the likelihood of an active manager outperforming goes up as he holds more stocks. More concentrated portfolios are more likely to underperform. The median return in this case is 10% for the one-stock portfolio. The median manager underperforms by 8%. The one winner outperforms by 32 because he has a stock that's up 50%. So in other words, in this scenario of skewed returns and relatively concentrated active managers, the majority of active managers underperform, and that enables a minority to outperform. And as we think about the future of the active-passive debate, my suggestion would be, and it's only a suggestion, is that the way it will finally shake out is that we'll get to a place where the majority, maybe quite a large majority, even larger than we see in SPIVA today, a large majority will underperform by a relatively small amount, and that will enable a minority to do spectacularly well. Obvious question is, what is a relatively small amount? And that's not a precise term of art, but an imprecise definition is not so much that you get summarily fired. Imagine a situation, for example, where 90% of the managers underperform by 1% a year. That means the 10% who outperform have an alpha of 9%. That's the kind of disparity I'm talking about. Final thoughts. Most active managers fail most of the time. The rise of indexing has saved investors billions of dollars in management fees without requiring that they make a sacrifice in performance. The growth of passive alternatives, including factor indexing and smart beta, has created an increasingly difficult challenge for active managers. And finally, we think indexing has considerable capacity to grow without damaging market efficiency. So with that, happy to have your questions, and thank you for your time and attention.
We appreciate the extensive information and your willingness to testify today. You've been in touch with the Commission and our consultant, and I would ask that if further questions are developed, that you would be good enough to continue to communicate with the Commission. It's important work that we're doing, and the work that you have done is important as it will be utilized for our final product. I'm going to withhold any questions I have in the interest of time. We're going to try and get caught up a little bit, but I'm going to give my fellow commissioners an opportunity to ask a quick question, brief. Mr. Chairman.
Real quick, thank you for your work. You often hear indexing makes sense for large cap U.S. stocks, but international, small cap, not so much. Your work clearly shows that's not the case, correct?
Absolutely. It's particularly in the small cap space. You know, on average, about 80% of small cap active managers underperform the S&P small cap 600 benchmark. That's a myth.
So, Commissioner Gallagher, if we go quickly, I think we're okay.
Yes, very quick. Fortunately, our systems apply an index-first mentality. So a lot of the ideas that you're sharing with us today have been shared in the boardroom, and so your ideas are carrying forth. I think the time frame of SPIVA is a little limited. I'd like to see it expand a little further back to give us a sense of real performance over a tumultuous time period.
Yes.
And then let me continue, thanks. And also just finally is that passive is an active decision, and it's not a zero-cost bargain. There is not a zero cost in it, and I'm afraid there's a misperception. So thank you.
No, that's fair, but any decision to invest in an asset class it can be classified as an active decision. The important thing in terms of cost is that the costs of passive are typically dramatically lower than the costs of corresponding active.
Thank you very much. Appreciate your testimony. And now we're going to be spanning the globe. We've got a next group of testifiers that are going to come to us through Skype virtually. So we appreciate you holding on. We're running a few minutes behind schedule. We're making some of that up. Matthew Clark manages investment functions for the state of South Dakota financial assets, including the South Dakota retirement system. We also have Robert Maynard, who's going to be joining us, and Mr. Maynard is currently the Chief Investment Officer for the Public Employees Retirement System of Idaho. So through our conversations, we believe that it's important for the Commission to get information on peer organizations, and the fact that you are managing pension funds and involved in their assets and investments is important for us to hear. We appreciate your testimony today. Yeah, I'm not sure who is up first. We are so close to getting you on screens that here in Pennsylvania we will all be able to see. So thank you for joining us today. Thank you for your testimony. And you are live.
Who do you guys want to go first?
How about we have Mr. Clark testify first? Thank you.
Can you hear me?
Yes, we can hear you now. Thank you.
Wonderful. My name is Matt Clark, and I'm the State Investment Officer for the state of South Dakota. The South Dakota Investment Council, where I work, manages all the financial assets for the state, including the trust funds and retirement system. I think you'll have a 7-page presentation that was provided where I'll discuss our goal, governance, investment policies, and staffing. I understand you may also have been provided with a copy of the transmittal letter of our annual report. That would talk about our long-term performance, future return expectations, and our cost of managing assets. On page 2 of the presentation, the Investment Council's goal is to add value over the long term versus market indexes. Our observation is that it's very difficult for most funds to keep up with the indexes. I listened in at the end of the previous subject, and we would concur that it's difficult to outperform. Thus, we think that if we can outperform those indexes, that's a good job, and we're adding real value. Accomplishment of this goal of beating the market indexes gives us the best chance to meet all of our obligations to pay our benefits and other distribution needs over the long term. We believe, though, given that we're a long-term investor, that everyone has to agree on your goal. Probably no matter what your goal is, everyone needs to agree on it if you're to have any chance to succeed. So to us, we think that comes first, and you really need to identify it. And for us, it's the win over the long term. And because of that long-term goal, we believe we have to sacrifice worrying about how we do over the short term. And on a day-to-day basis, our investment team and myself, we focus on updating our assessments of fair value for all of our assets and maintaining our discipline. We do not look at short-term performance at all. On page 3, there's discussion of governance. Similar to a few other states, the Investment Council and the retirement system have separate boards. I think you'll hear that that's the case in Wisconsin and Florida later as well. This allows the investment function to be overseen by individuals that are selected on the basis of their investment and business experience, as opposed to merely being a constituent of the retirement system. To aid in coordination, the executive director of the retirement system sits on the board of the Investment Council, so he's one of my bosses. Likewise, my position sits on the board of the retirement system, so I'm one of his bosses. The legislature appoints the majority of Investment Council members based on the experience requirement, and the legislature also approves our annual budget and a 10-year long-term business plan. The governor can also recommend changes to the budget and definitely monitors the impact of investment performance on the state's overall financial condition, as that's important to the state staying sound and to our rating agency issues. The council selects and monitors my position, the state investment officer, and their primary focus, other than that, is to maintain a non-political environment. Some of the details of what they do is they establish the policy benchmarks, what our asset allocation benchmark is, the benchmark for each asset category, and then the ranges around the benchmarks. They also approve the budget, the compensation plan, and the long-term plan. My position and the rest of the investment team, we recommend the policies to the council and implement all the investment programs within the approved policies. On page 4, a business-like environment is encouraged by selection of successful business executives as council members, by focusing on maximum risk-adjusted returns, by maintaining the long-term business plan, and that's intended to foster a stable environment for internal management. And essential to that is being able to hold on to successful investment staff. Also, it's important to fund the assets or the budget from assets under management. That makes it easier to have a business-like approach to budget issues. The emphasis on budget matters is on managing cost as a percentage of assets, what we call unit cost. Our internal cost here are targeted at approximately 0.1% on average. On page 5, the investment process is focused on long-term value, which for us is the present value of future cash flows. Our research focuses on the estimation of probability-weighted cash flows and on risk assessment, which affects the discount rates we use to discount cash flows to present value. We believe the only reliable way to add value long-term is to buy when valuations are cheap and sell when expensive. We want to be that 1 out of 10 managers that wins at the end at the expense of the 9 out of 10 that may underperform, discussed in the previous presentation. Many investors in our minds would rather focus on achieving favorable results in the short term, but we just think chasing immediate gratification is just too crowded for us to succeed. So we try to go where no one else wants to go, which is the very long term. Now, it's difficult to stay focused on the long term, and so there are some things that we have found that can be helpful to maintaining that discipline. The most important is to have common sense measures of long-term value. Also helpful is to have successful experience navigating past cycles. That boosts your confidence and helps you understand the amount of patience that's required to be a long-term investor. Finally, contingency planning we think is essential to have a roadmap so that when tough times do come, you have a plan and you're not having to figure out what to do under duress. Most assets are internally managed. This would be pretty much all the publicly tradable assets. This can save money as our internal costs are lower than external active management. We do manage everything actively as well, that is internal. Internal management can also improve returns, at least we believe they can, and they have for us. And we think that's because we have a greater ability to keep our teams focused on long-term value internally. And also we think that doing your own work increases your conviction. Of course, doing asset management internally involves a lot more work, requires a lot more internal resources, but has been worth it for us so far. Risk measurement focuses on the overall portfolio equity-like and bond-like risk. This includes embedded equity or bond exposure from all asset classes, not just stocks, but private equity, high yield, real estate, and so on. Conventional statistical risk measures are calculated, but they're adjusted to reflect the higher real-world frequency and magnitudes of market crises. Risk is managed through diversification and within the permitted asset allocation ranges by reducing exposure to overvalued assets so that when the markets do stumble, you suffer less. A strong financial condition is also essential to being a long-term contrarian investor. That helps you stay the course through difficult periods. To aid this, we focused on migrating to a hybrid pension model. The outcome is 100% funded status with additional benefit flexibility so that we can maintain 100% funding through a reasonable range of market outcomes. This makes it much easier for the investment process to focus on achieving the highest risk-adjusted long-term returns. On page 6, investment staff start as interns that are recruited from area universities. We look for top-of-the-class students with emotional resiliency necessary for a contrarian approach, and that have technical aptitude for our cash flow modeling that drives our investment process. We also want them to have an appreciation for our region, that we want them to want to live here and to appreciate our mission. Training is focused on the rationale behind our approach, why we're a long-term contrarian investor and how we evolved the approach to the current process, and also how it fits into our competitive position. And then we really drive home the cash flow modeling proficiency. Once they're trained and put on a portfolio, a buddy system is used. There are 2 portfolio managers who also serve as analysts assigned to most industries. This allows internal discussion to happen and aids continuity if someone leaves. Each of these portfolio managers / analysts manages their own portfolio. We think this helps heighten focus and accountability. And finally, on people, compensation is based on private sector comparable positions with a discount and is linked to added value through an incentive compensation component. That's described more on page 7. So that compensation is linked to added value versus benchmarks. Incentives are mostly longer term, tied to 4 and 10-year performance. That encourages investing for the long term, and there's a large component of stretch incentives to encourage maximum performance. The use of performance incentives causes pay to vary up and down with performance. This helps us keep successful team members when they're winning, because our winners are most attractive to competitors, and so we want to make sure we pay people extra when they're most attractive to being stolen away. Also helps save money by paying people less when they're doing poorly and are less sought after. We also think it's important that incentives encourage adding value in difficult markets when we need the extra return the most, and not just in up markets. And that's the end of my prepared remarks. Be happy to take any questions unless you want to wait until after Bob goes.
It's okay. Why don't we go ahead and hear testimony from Mr. Maynard, Public Employees Retirement System, Idaho. Thank you, Mr. Maynard.
Certainly. I'm Bob Maynard. I just want to check at the start here, is my volume level appropriate, or should I yell or whisper?
Yeah, we can hear you just fine. Thank you.
Okay, great. And secondly, I'm not sure who's controlling the slides going forward. And am I controlling them from here? Are you seeing me, or is there someone there who's advancing the slides?
So we can do it from here if you give us an indication when you want to move to the next slide.
Perfect. I'll give the indication. It's a pleasure to be here. It's a pleasure to be here with Matt as well. I'm Bob Maynard. I'm the Chief Investment Officer for the Public Employees Retirement System of Idaho. We're about an $18 billion fund. I've been in this business since the 1980s. I've been Chief Investment Officer at Idaho since 1992. And one of the things that, as this commission probably is realizing, one of the big changes since I got into business is that the range of ways of people to appropriately invest a portfolio have widened dramatically. The width of the spectrum of appropriate ways to invest is unbelievable. We tend to be on the simpler side of the equation, more conventional, but there are many different ways. And you have 3 of my heroes here in investing, testifying between Matt, David, and Ash. And we do completely different things. Washington State Investment Board has even more private equity. And any one of these can be appropriate. appropriate. The key is to make sure that the way that one invests is appropriate for the history, the tradition, the particular liabilities, the nature of the constituency, because one thing that we have found in our industry over the last 40 to 50 years, it's not what you do, it's whether you can keep doing it consistently over the years. You'll find that the better performing funds have been consistent and not switching back and forth depending on this slings and arrows of outrageous markets. For us, for Percy, we have found for our particular condition that a conventional investing, as traditionally explicated, is best for us. I'll go through these points in going forward, but the by the way, I intend to talk about another 10, 15 minutes and then stop for questioning if that's appropriate. You can cut me off earlier if you wish. But for us, our particular liabilities are set up that we only need to make market returns. An appropriate, diversified market return over a 10 to 15 to 20-year period is more than enough to meet the conservative nature of our liabilities. We only need to make about 3 to 4% above inflation over time. We have a small staff. I'm holding a staff meeting right now with one person absent. We have 2 professionals on staff. And I don't do much even with that. We have a lay board of 5 people. We're a retirement board, and a conventional approach for us is easily tracked, easily followed, and easy to explain to our various constituencies when times get bad. It has given us more than adequate returns over the 25 to 30 years we've been doing this, and it's relatively very, very easy to do a straightforward approach. And more importantly, we spend a lot of time looking at what other people are doing, and we have found that over the decades, more complex approaches, while sometimes do extremely well. Matt is a particularly great example of that. As an average, hasn't necessarily proved itself over time. A lot of the innovations that came up this millennium haven't, portable alpha, 130/30, generally the hedge fund movement, things of that nature, on average, have not yet proven themselves. They're more of a matter of faith and fact. And we would rather see something stand the test of time to survive a crisis before we'd be willing to add it to our portfolio. So on the first slide, as you might be able to see, is that our conventional investing, our idea of conventional investing, is that it's simple. We rely primarily on the public markets as traditionally defined. Generally, we're 70% equities, 30% fixed income, trying to get 4 to 5% real returns. We're looking to be transparent. We rely primarily on liquid daily price securities. We do have private equity and private real estate, but they're standard. They're the names you generally know. We do have some local programs, which actually is kind of the reason we have private equity in the first place. And our private real estate is relatively simple with 20 to 30 properties. We tend to be focused. We use the 10 traditional asset types. We don't use hedge funds. We don't do currency hedging. We don't do high yield debt. And we tend to try to be patient over a 5 to 10 year time horizon. We recognize that the markets and in a 1 to 4 year period are not normally distributed. They're abnormal. It's earthquake land. And so as a result, we're just set up to just ride those babies out. We don't try to avoid them by doing anything special with regard to tactical asset allocation. We have found that this produces long-term returns in our equal or better than generally alternative approaches like the endowment models, particularly in rough times. You can go to the next slide. Here are the slide before portfolio decisions. Basically, there's 5 basic things we focus on. Do we determine the basic equity fixed split? 70% for equities, 30% for fixed income, for 3 to 5% real returns. We have a home country bias. Many people split their equity orientation equally between U.S. and international, following the world capitalization for various reasons. We like a home country bias for 2 or 3 reasons, one of which actually is we tend to believe the economic systems and the Anglo-Saxon countries it may not just be an accident they have outperformed over the long term, even not having lost world wars. The third choice is additional diversification and other additions of the portfolio than simple equities and fixed, and we tend to use the 10 traditional asset types. The fourth is monitoring drift and rebalancing. That is the 4th thing we concentrate on. And when we have done those 4, that covers about 99.5% of our returns. The least important part in terms of impacting our overall portfolio is active versus passive management, what that active passive split is, and we tend to be 50% indexed in the public sector overall, actually. We have 35% traditional active managers and 15% private equity, fixed income, and some local commercial mortgage program. Next slide, please, the 3rd slide. These are our base allocations. If going from left to right across your radio dial, we have 11% small cap, 18% U.S. large cap, 8% private equity, 8% about real estate split between public and private, about 10% emerging, 15% developed market international, 15% standard high-grade fixed income, 5% in a local Idaho commercial mortgage program that we directly own, and 10% tips. That tips allocation and the emerging market allocation tends to be a little bit higher than our peers, but otherwise it's a pretty standard allocation. If you go to the next slide, this is our manager, core passive, 50%, basic exposure to the public markets, does a lot for cost control, and for risk control, rebalancing, makes for easy transition. It's the main thing we move money around to fund. We're generally a net payout during the year, so when we rebalance, we tend to do it through the index fund. Our active managers are about 35% of the active public managers are about 35% of the portfolio. We tend to favor clear styles or concentrated portfolios. We don't use black boxes. We don't use 9-box structures. We don't really do a lot of careful control of what they're trying to do on tracking error. This is more for risk control rather than necessarily trying to beat the market. We are not depending on active management to get us where we want to go. We want concentrated relationships. We want to be able to easily see. We have attempted in the past, we basically don't want our active efforts to fail us. If we, like I said before, if we get reasonably diversified institutional returns on a basic portfolio over a 15 to 20 year period, we'll be fine. Right now, so the next slide. This is our, if you were interested, these are how our managers, all the white are where our index funds are. And you can see 50% of the total portfolio is, and this is as of this morning. Next slide, please. Why are we doing this? Well, again, we have very conservative needs. We only need to make market returns. Our discount rate is 7% nominal, net return 4% real. We have a 3% inflation assumption. If inflation's higher than that, we need to make more, but inflation's been below that, so we can get away with making less. And like for us, there's no evidence that complexity adds to returns. Generally, we do have historically, this is Idaho, we're going to have a resource constraint. We have a small staff. Our board is a lay board that does the retirement. We're a retirement board that does both the all teachers and public employees. Most of the cities, most of the hospital districts are in our system. Our in-house budget is appropriated, and all of our actions are public actions. We can't do anything in secret here. So there's resource constraints preventing us from doing very intricate investment approaches. The control is a lot easier. The simpler portfolio, the easier it is to monitor and operate. And there's other reasons too. It's easier to explain with well understood concepts to our constituency. During the crises of the late 90s, of the tech wreck, we didn't get, it was easy to explain to the legislature, to the administration, and to all our teachers and everybody what we were doing, why we were doing it. They could read the headlines and generally see where we are. Given the fact that we're half passive, it's relatively inexpensive. Our overall costs are under 30 basis points, so that it's relatively cheap. Our constituency has accepted this through crises. They've shown patience with us. And by the way, when I got here, the system was in turmoil. We were 60% funded. I was the 5th chief investment officer in 4 years. They had gone outside. They had been at local bank trust departments. We were in the headlines all the time. We were at the bottom of the peer universe. So switching everything to a simple approach has worked to us. Given us competitive returns, both in normal and crisis periods. Next slide. So generally, this has worked overall. By the way, we tend to believe, I've been on what I call the Swenson J-curve. There is a David Swenson who runs the Yale portfolio, basically has some lecture series and whatever, but he explicates an idea that he believes very simple can work and very complex can work better, like Yale does. But he makes the comment that while simple can do quite well and well-executed complex can do even better in his mind, it isn't a simple direct path that as you add complexity, you do better. What actually happens in his mind is that as you add complexity, at least initially, you do worse because you add fees, you get into areas where the average return doesn't get it. You've got to be top quartile private equity. You got to be top quartile hedge fund. If you get the average return, it makes it worse. And so as a result, he basically says when he gave a book as to what the individual investor to do, it was saying, don't try this at home, kids. Next slide, please. This is what he said in 2005 should be what the average person should do using public market index funds. I'm going to come back to that because this is another example of a relatively simple approach. Next slide, please. This shows basically this slide and then go one more slide in the future. For us, these returns have generally given us a top third, top quartile over the long term on peer reviews. And that's not because, as you can see, we're not doing anything special. It means the average complex approach tends to do worse than average over the long term. When we do better than most, that's not because of us. We've done the same thing since 1998. Next slide, please. You can also see that from our perspective, this is the time, by the way, those last slides were as of the end of, last June 30, the last fiscal year, a month and a half ago. This is our returns through 2009. This encompasses two crisis periods, the tail end of the Asian crisis, then the tech wreck, and then 2008, 2009. And this simple approach for for us worked. It kept us pretty high in the peer rankings around, and that's why you're going to see us kind of stick where we are through the next crisis, because as of right now, we're pretty well funded. Our actual report just came in for the last fiscal year. We're 92.1% funded. We have a 13.9-year amortization period. Our contribution rates are just under 19%. For the employers and employees behind, 7 to 8% for the employees, 13% for the employers, and our Social Security state as well. So we're in adequately pretty good shape. But it isn't just our particular approach. Next slide. You can see that this is that Swenson portfolio I showed, how they were doing for the 5-10 years going through the crisis in 2012. By the way, I'm pulling this from a previous presentation I did a few years ago. I haven't updated it, but it's still pretty good. But you can see on the top line the return of that simple peer portfolio, Yale's returns through the crisis, the median endowment, and you can see the rank of that simple portfolio in the foundation and endowment universe. For a long period of time, Swenson beats Swenson, even with that simple portfolio. Next slide. Well, this is another one showing that you can see that later. Next slide, please. This is not necessarily an easy approach. It's easy to implement, but the problem with this approach is there's an old saying that in order to perform, and I understand my 15 minutes is up. This will be my last slide. You need emotional. You either got to be intellectually exhausting, physically exhausting, or mentally exhausting. Physically exhausting is that you've got to be you got to work harder than anybody else, but there's a lot of people doing this. The intellectually exhausting is you got to be smarter than anybody else, but being smart, well-resourced, intelligence just gets you in the game. This way, the simple, straightforward approach is the third way, but it's emotionally exhausting. You need to wait 5 to 20 years. You depend on equity, risk, and return. You've got to accept short-term roller coaster volatility. You abandon the quest for higher than market returns. It's boring. You've just got to sit there, and at most in a crisis, you rebalance, but you don't do anything else. And most importantly, the assumptions of normal randomness, coin tossing randomness, simply do not apply in the shorter term. Actually, if you can go one more slide in. This is a Rorschach ink blot test. Same phenomena, no doubt. Now, what are these phenomena? Next slide. The first slide is that of the Sumatran earthquake back in 2004. The second slide is the S&P daily price movements for 8 years in 2002 to 2010. They're exactly the same phenomena. Long periods of quiet, then earthquake movements. If you go to the next slide, this will be my last one. If you look here, the dotted line is normal randomness that most of the risk control the systems are built on. Most of the mathematics are there, but the world is not like that. You have high peaks and fat tails. Because of that phenomena, very complex ideas based on mathematical approaches are problematic, and we want to see some of the ones that are being advanced now actually prove themselves in a crisis. But until then, we're perfectly happy being simple and straightforward. So I'll stop there and wait for any questions you may have.
Bob, thank you very much. And Matt, thank you as well. Very interesting. We appreciate the fact that you've sped through your presentations, and we'll give the commissioners a bit of time to ask questions. I just had one or two. So this concept, I'm interested to study a little bit more this J curve developed by the individual from Yale. Just want to read a little bit more about that. But I think that potentially complex systems comes from complex governance. And Matt, you mentioned the fact that you're 100% funded, and that you are largely, your council is largely appointed by the legislature and the governor. How large is the council? And tell me about the criteria that are required to appoint people to those boards.
The Investment Council itself, hope you can hear me, is comprised of 8 members. 3 are ex officio, the state treasurer, the school and public lands commissioner, and the executive director of the retirement system. The other 5 are appointed by the bipartisan executive board of the legislature, and they're selected on the basis of education and training and finance is a statutory requirement. On a practical basis, they're leading business people in the state. I myself will provide them a short list of candidates in case they don't have anyone in mind themselves, and so we end up getting the highest profile business people in the state, the owner of a chain of community banks, or the CEO owner of a manufacturing business, or a CFO here and there, and once in a while a finance professor. And so that's the general nature of the board. The governor themselves don't play a role in appointing the board, although I work closely with them on rating agency issues and things like that, because we do affect each other.
Great, thank you very much. Matt, how does that compare to what you're doing in Idaho? And it appears, again, that you've been able to implement a strategy that's relatively simple. Now, you were underfunded some years ago. What's your funding percentage now?
As we speak today, it's 92.1%. That's a standard entry age normal, and our amortization period is 13.9 years. With regard to ours is a much different system than Matt's. We have a 5-member board. 2 members are retired, are people active in the system of at least 10 years standing. They tend to be heads of agencies, and 3 people are general business people from the community. The governors have been very good. They're appointed by the governor, 5-year terms, confirmed by the Senate, staggered terms, no provision for removal. So they serve, and they're fairly stable. We have always tended to have trustees who have been on 10 to 15 years of longstanding trustees, and generally they're high-ranking people. But we get them on the board to say, "Look, they have other lives. This isn't the most important thing in their life." So we make a commitment to them that on the investment side, we shouldn't take more than 2 to 3 hours a month, and that also constrains making it more. Making our structure one that can be easily explained to a lay board. High quality people, but something that we should be able to explain in plain English in 5 minutes. We have a relatively good reputation in the state, but as you all know in this industry, stuff can come up like a hurricane, and all that will get us is that if something goes wrong, instead of hanging us immediately, they'll give us 5 minutes to explain. And if we can't explain it in 5 minutes, we're not going to do it. So our board meetings on the investment side are basically, we do half an hour to an hour a month, and that counts reviews of the programs, and try to keep, and they delegate stuff down, and the only argument is keep us informed, make sure there's a double check, and if something goes wrong that we weren't aware of before it went wrong, you're fired. So that's kind of our approach here.
Okay, thank you very much. I appreciate it. Mr. Vice Chairman, questions?
Thank you both very much. Mr. Maynard, to you mentioned your simple strategy means abandoning the hope of kind of outsized returns, but your return assumption is 7%. You think your simple strategy comfortably delivers 7% return over the long run?
Yes, and more importantly, we've had a 3.5% to 4% real return because our inflation is 3%. If inflation's above that, we're going to have to pay out more because ending salaries will be higher. But if inflation's below that, like it's been for the last 10, 15 years, we don't have to make 7%. It's a lesser burden. And if a 70% equity, 30% fixed income split doesn't get us 3 to 4% real returns over a 15 to 20 year period, the condition of the pension fund is not going to be the front page headline. That means a comet's hit the earth. I mean, the equities tend to give you 5 to 7% real over prolonged periods. Bonds, 1 to 3% real. We're very comfortable over the long term. Even for the next 10 years, we're going to be able to make a 3.5 to 4% real return obligation.
Thank you. And Mr. Clark, if I read your annual, recognizing different funds account for cost differently, but if I read your report properly, your all-in cost, Mr. Manager, were 30 basis points. So you're on the order of 40 basis points for all cost, internal and external?
For ours, this is Bob Maynard. Our total costs are 34 basis points, counting running the defined benefit the payout operation, everything. The investment side of that is 28 to 29. By the way, we are not a fund that thinks carried interest is a fee. So that if you're doing that, but our private real estate right now is only 6% actually invested.
Okay. And Matt, yours is about 40 basis points?
Yes, our internal costs are 10. So that's the office rent and all the investment team. And then the outside managers add 30. Though they only have about a quarter of the assets, but they tend to be high cost things like real estate and private equity. And the 40, just like Bob mentioned, does not include carry.
Right.
When we do really well, and the real estate, for example, does really well, then our fees are going to be high because they get 20% of the profit. But, we want that given that we get 80%.
Thanks.
Okay, thank you. Commissioner Gallagher?
Thank you, Mr. Chair. I'm thrilled to have both of you on this conference call. I've learned a lot. I think there's a lot of thought leadership that we can garner from this. I do want to ask a question. Now, our systems were starved employer contributions for 15 of the last 20 years. Would you be able to do the theses you're following given that context? I mean, I see that South Dakota is sitting on 25% cash. I think our trustees would be going bananas about that. What is it? Would you be able to do there under the same
Not a
context?
chance. Not a chance. If I was sitting in the situation you're in where you didn't pay your contributions for 10 to 15 years and we were down below 65% funded or 60% funded and had a real return obligation like many funds or endowments of 5, 6, or 7%, there's no way you could do the type of investing that we're doing, the simple, transparent, focused, easily explained. I'd be doing something entirely different. But we're only able to do this. I mean, Idaho is is a agricultural state, farming state. It tends to be one of the reddest states in the nation. Whatever one may think of the politics, they have been heroes with this defined benefit system. They have always paid the contributions. They have always been reasonable about what they're promising in benefits. When they increased benefits in the 90s, they paid for it with contributions, and they let us go in and directly pull the money from treasuries across the state if someone doesn't pay. So it was a different system. If I was sitting there in Kentucky, if I was sitting there in Illinois, I couldn't do what we're doing. I'd have to work for a living.
Yes, thank you, Mr. Maynard. Mr. Clark, do you have any comment on that? I see that you're on about 25% cash. We all stand on the shoulders of giants to help us do what we do. What enables you? What kind of governance structure do you have in place there that allows you to kind of hold cash like that, or just take the approach that you have, the contrarian view?
Well, we have a long-term focus, and we've always had the attitude that this is our people's money. How should we manage it like it was my friends and neighbors and relatives' money? And if we had their money, well, we would think about how much risk we should take if markets were fairly valued. Our answer to that is the same as what Bob mentioned before, 70-30. But we also have the idea that when markets are cheap and you're going to get above average rewards for bearing risk, you should take more risk when you're paid more to do so, and you should take less risk when the prospects for earning the equity reward is diminished. And so we have a range. For us, our equity risk is 50 to 85. And 70 is neutral, and we're at 50 because markets are very overvalued on our valuation work. Our governance model is basically that we're going to run this for the long term. We're not going to care about the short term. We're going to pile up as much money as we possibly can. Every year we show how many, hundreds of millions or billions of added value we've added above the benchmarks by following this long-term contrarian approach. And we have no critics for that. Everybody understands it's endure short-term pain for long-term gain. We fully describe that that's why we're getting our rewards. We're not outsmarting anybody. Bob talked about that before, how, that's a tough game. Nobody here is going to get into the elite class at Stanford. And nobody here is going to outwork the folks at the hedge funds. All we can do is out-suffer them by enduring short-term pain and being patient. And so that's our competitive advantage, and we play to that. We advertise that heavily in the state, and everybody understands that, and they've seen the rewards from it in the past, and they're happy to continue doing that. And so we have those wide ranges. When people come on the board, they understand all that before they get on the board. And if they don't want to be interested in that, well, then one of us will have to go. And I'm still here after 35 years. And so that's basically our approach. And we're pretty blunt and simple about our competitive advantage, and that we need people that will nurture that. And if they don't have the stomach for it, well, then they should, get on a different board. And we think that since we're managing our people's money, we want to do what makes sense. And the retirement system liability has to adapt to the realities of the world. We're investing based on the world as it is, a realistic assessment of it. And we don't say, well, gee, we need X amount of money, so let's, take on more risk than is prudent to try to get that or whatever. We just invest the same way with our people's money based upon how attractive the opportunities are without regard to our funding status. And if we were 200% funded or 20% funded, we would do the same thing.
Okay, thank you. Just one final question from Commissioner Bloom, and then we've got to move to our next testifying group. Thank you very much.
A couple of questions. How large are your staffs?
This is Bob Maynard from Idaho. Like I said, I'm holding a staff meeting right now with one person absent. We have two people, two professionals. Well, that's counting me as a professional, which may not actually be accurate. But Rochelle Sugiyama is my investment officer, and that's it. We have fiscal in our fiscal section. We have one position, although but there's about two people that actually cover our stuff, and I have an administrative assistant.
Mr. Clark?
For South Dakota, we have 34 people in the investment division. 2 are administrative, 4 are CPAs to keep track of everything, and 28 are investment professionals.
Both of you gentlemen mentioned the fact that you don't count carried interest as part of your costs. Is the carried interest public information, or is it private? I'm not going to ask you for it. I'm just asking you, is that public information or is it private?
For us, it's on an individual basis. It's not in our CAFR, I do not believe. We treat carried interest like we treat consistently with what we do in real estate when we do joint ventures, where we put up the cash and there's a joint venture partner that, where they get 5 to 10%. We don't treat that as a cost there, and we don't treat it that way in private private equity, although we recognize the argument for it. I just want to make sure that whatever we do, my accountants, my actuaries, the legislative auditors, all that, are looking at the same thing. Back in the 90s, we had 4 or 5 separate books based on how people were valuing things, and we just want them all on the same page. With regard to private equity, back in the 90s, I basically locked them in a room and I said, you all agree. I don't particularly care what it is, but as long as you all agree, I'm fine. And they came to an agreement. We're reluctant to change that agreement unless there's a real industry consensus, which is still developing right now.
One last question. You hire outside consultants and outside money managers. How much of that is brought to your to the boards that you report to? Is there discussions about those managers at the board, or just done professionally inside the organizations?
This is Bob Maynard again. Our consultants work for the board and with staff. So our general consultant, Callan, our private equity consultant, Hamilton Lane, our real estate consultant at Callan, they work for the board and report directly to the board. With regard to what the board actually discusses during meetings, they really don't spend hardly any time at all on the active managers. Like I said before, with regard to the 5 things that we do, active management, if it adds 10 basis points plus or minus on net fees to the fund, plus or minus in a year, that's exceptional. Whereas the rebalancing decision adds 30 to 40. So they spend all their time on the more general issues and spend very little time, except active managers do provide entertainment value, and I'm not talking dinners. I'm talking some marketing intelligence and things of that nature. They will talk to active managers occasionally, but it's more for fun and interest than it is about thinking that that's going to make a huge difference in terms of the annual performance of our fund.
I've always thought that the presentations they made were very, very good help to me to fall asleep. Mr. Clark, do you have anything to add to your active managers and whether your boards have anything, get a chance to talk to them, or do they approve them or anything along those lines?
Most assets are managed internally if they're publicly traded. The exceptions to that would be a few niche areas or educational based relationships. The primary use, though, of outside managers is private equity and especially real estate, because we invest through partnerships there. And for that, it's a staff-driven process. Staff sources ideas, does the due diligence, determines whether to recommend a manager or not. And then if we do, then we bring it to the board and they give final approval. We don't have any minimum requirements or targets for any of those partnership investments. There's a default publicly traded index that money would be invested in if we don't find a partnership manager that we like. And so it's not like, we have to bring in 3 and they pick one. If we like one, we bring it in. They basically audit our due diligence work and make sure that we're consistent with our strategy and game plan in picking managers and our philosophy. And then as to consultants, we don't use any investment consultants.
Thank you very much, gentlemen. I really appreciate you answering those questions.
Okay, thank you again for your
It's been a
testimony.
pleasure.
I would ask that as we move forward, we appreciate the fact that you're willing to testify. We appreciate the information and the good work that you've done within your organizations. And as we move forward, we'd really appreciate if you would continue to be in contact if we have special requests of the great work that you've done from either our consultant or the commission. Thank you again.
More than happy to. Thank you.
Good luck.
Thanks. Appreciate that. So we'll get online now, and I will apologize as we move forward to Rochelle Klaskin. She is the interim executive director and chief counsel for the state of Wisconsin's investment board. And I believe that she is joined by David Vila, chief investment officer, state of Wisconsin investment board. And I think we have a third person on the next panel, but David and Rochelle, if you were the first two up, I'll go ahead and let you go first in whatever order you wish. Thank you.
Great. So we assume that you can see us and you can hear us. Is that correct?
That is correct. Thank you.
Fantastic. Well, I am Rochelle Klaskin. I'm the interim executive director and chief legal counsel here at SWIB, the state of Wisconsin Investment Board. Sitting to my right is David Villa, our chief investment officer, who has been with SWIB since 2006. So we had the benefit of a few of your questions, so I'm going to address a couple of those as well when I just introduce who SWIB is to you and what our plan looks like. So currently we manage approximately $110 billion. The vast majority of that is the Wisconsin retirement system, which makes up about $102 billion. We also manage the state's money cash pool account called the State Investment Fund, and then 6 other small funds for other agencies of the state. We have about 200 employees, 40% are investment management professional staff, and about 60% are investment services that range from operations, technology, HR, legal, and so forth. Our plan was consolidated in 1982, so the Wisconsin retirement system covers the majority.
Rochelle, I don't know if you can hear me, but we have lost you momentarily, so please sit tight. Thanks.
The WRS board, and they have 2 constituent boards as well, but the WRS is the main.
Rochelle, I'm going to just have you.
Governs that.
I'm going to have you just hold on for 1 second. Can you hear me? Okay.
Yes, I can.
Yeah, we lost you for a second. Summer, can you tell us where we were when?
All right. Can you hear me now?
Yeah, just 1 second, please.
Okay.
We thought it was bad before.
Just so you know, something's working. This is Ash Williams down in Florida. I'm hearing you perfectly.
Sounds good, Ash.
Okay, so Summer, again, just tell me where we lost you for a moment. Here's where we lost you.
Okay.
Your plan was consolidated in 1982. Thank you.
Okay, so consolidated in 1982. The plan is a single plan that covers almost all employers in Wisconsin, which is about 1,500 employers, other than the city of Milwaukee and the county of Milwaukee, who maintain separate plans. We have the investment board, which I'll actually go through who serves on our investment board, which is in just our sole mission is to manage the assets. And then the Department of Employee Trust Funds is our sister agency in the state, and they manage the liability and the plan administration through a WRS board. They also set the assumed rate for the plan, which is 7.2%, and they set the contribution rate for employees and employers. In connection with who serves on our board, we have a 9-member board. They are appointed to 6-year terms. It includes the Secretary of the Department of Administration here in Wisconsin, a constituent member of the Teachers Board, so someone who represents all the teachers of the states, a local government participant. Currently, that's the county administrator of a larger county here in Wisconsin, and then 1 member of the WRS board, and that historically is always the secretary or the head executive of the Department of Employee Trust Funds. The governor then appoints 5 other members who are confirmed by the state Senate. and 4 of those under statute are required to have at least 10 years of relevant business and investment expertise. Inside of SWIB for the WRS, of the $102 billion, we manage internally about 60% in both active and passive strategies, and overall, 50% of our assets are managed actively. In connection with a few of the questions that were sent to us ahead of time, I think I'll just start off. I also serve as chief legal counsel. So the number one thing I always think a lot about here at SWIB is our fiduciary duty, both to the trust fund and the beneficiaries. And so in connection with combining a plan, you do have to think about the governance, because the governance of that investment board is either going to challenge your success or it's going to help you succeed. In our case, the board, and in connection with Pennsylvania as well, the board owns that fiduciary duty, and the fiduciary duty is the highest standard under law, which is the prudent expert. Now, the board, of course, can delegate some of its responsibilities, but it always retains the obligation to delegate to experts and to oversight that delegation. So when we think about governance here at SWIB, our board is a policy board. All of these specific investment decisions are delegated to professional staff, who then have a number of governance checks and balances and other controls internally to manage conflicts of interest or anything else that may arise. So our in-house staff has that expertise, both from engaging with external managers as well as internal expertise to actually run the complex investment strategies that we do in-house. So I would think as a number one factor to think about in connection with combining to a single board is what kind of governance do you want to set? What policies do you want to set from a high level? And then ensuring compliance with those policies. Another very important duty of the fiduciary duty is that when you have a policy, you follow it. So these things are not just sort of written on the wall and forgotten about. They have to be part of who you are as an operating investment manager. In connection with we'll get into more of the details, but I'm going to let David sort of speak to some of the more specific things in connection with our investment strategy. And he wants to focus on a few things, including active internal management, the importance of funding the plan over the investment policy allocation, and then cost savings and economies of scale. So David.
All right, so I'm going to boil this down into 4 points. The first is that economies of scale and having investment professionals, although Bob and his staff person are maybe another way to look at this, but the economies of scale and investing in professional staff can save about 20 basis points. So in the context of a $100 billion plan, that's about $200 million a year in savings. But I want to put that in the context of the total plan and funding. So that's my second point. If a fund is 60% funded and the return is 7%, the real effective return on the liability is only 4.2%. So if we stay with kind of a $100 billion fund as the context, the target for the fund is to make about $7 billion a year in value creation. If you're only 60% funded and you earn 7%, you're only going to create $4.2 billion of wealth. The deficit is $2.8 billion. If your payout rate, if your net payout rate, so the net of your contributions and your benefit payments, is negative 2.5%, the fund will default in 12 years. So the 20 basis points means nothing. That's my third point. Saving 20 basis points in lower costs, whether you do it with Bob Maynard's approach or the Wisconsin approach, in the context of being 60% funded, is almost meaningless. My fourth point is the math. I'm not going to use earthquake math. I'm going to use math we learned in the last century. So the math is simple. A fund invests $1 and earns 7.2%. In about 20 years, the fund will have $4. If the $1 is not invested, the guarantor of the pension or the promise has to come up with $4. And if no provision has been made to provide the $4, the situation is indistinguishable from stealing. So that's my fourth point. So I hope nobody runs out of the room screaming. But I can take questions, but it's a pretty simple story from our point of view.
And coming from the fact of a plan that's almost 100% funded, which makes our lives a less roller coaster view of investment strategy.
Yeah, and it would be interesting to compare our benefit with Bob Maynard's benefit, because our benefit ranks about 19th among state plans, and our contribution rate is about 13%. So Bob Maynard's contribution rate is almost 50% higher than our contribution rate.
Thank you. I think we have one more testifier here in Ash Williams on this panel. Ash, do you want to testify now? You're on the line?
Yes, I am.
Okay,
Thank
great.
you very much.
Executive
And
Director and
I
Chief
think-
Investment Officer of Florida State Board of Administration, one of the nation's leading public investment organizations, institutions. Thank you, Ash.
Thank you very much, and I appreciate the opportunity to be with you today. And I would say that the wisdom you have received today is substantial and reflects, to the best of my knowledge, the best and clearest thinking you could have on the issues you're dealing with. I focused the materials that I prepared for you on the subject of consolidating investment operations for multiple mandates under a single consolidated investment organization, and the benefits of doing that, and some of the things that one would need to consider to do it. But I really think the points that David Vila just made are so fundamental, so important, and so ahead of anything else that you really should take a moment and listen to those. Florida is an interesting case historically that illustrates some of what David was talking about. When the Florida retirement system was created back in the early 1970s, it was created specifically in response to there being a large number of state and local government pension systems around Florida that were all operating independently. And the one thing that they shared as a common characteristic was either acute underfunding or chronic underfunding or both. And so the state legislature, in its wisdom, decided that that was a problem that needed to be bounded because it otherwise threatened the credit quality of the state of Florida. We are, by the way, AAA credit today. And so they put all of these plans together, and they did three simple things that are all fundamental to the success of any pension plan. First, they rationalized and standardized the benefits to make sure they were reasonable. They were not excessive and were not subject to a lot of gaming. Secondly, they took steps to ensure that to the extent there were ever any changes in the plan, they would be properly funded. There's a constitutional requirement to that effect, and the Florida legislature has done a terrific job over the years in making the annual actuarially indicated contributions, with one small exception I'll touch on in a second. The other thing they did was say, gosh, this is a disastrous fund as it now exists at its newly created point. Its funding ratio was in the 40s, which by just about any metric would cause most analysts to say, this thing is hopeless, dig a hole and bury it and forget about it. It's never going to work. But in Florida, the feeling was, well, if we really stay committed to paying the full normal cost each year, and in addition to that, making the full actuarially indicated contribution to defeasing the unfunded liability within 30 years, then we would anticipate being fully funded in no more than 30 years. And the third thing they did was ensure that there would be prudent management of the corpus of the pension fund, by giving that responsibility to the State Board of Administration, which is designed in a way to take it largely outside the day-to-day political process and to focus as much independent professional expertise on the investment outcomes as possible without having to deal with the oversight of a day-to-day operating investment committee, getting involved with all the manager decisions and buys and sells and fine-tuning and that kind of thing. So all of that is delegated to professional staff, our 3 trustees who are statewide elected officials, the governor, the attorney general, and the chief financial officer, hire whoever's in my job. They accept a high-level policy statement, investment policy statement that covers all of the big picture design issues of how the investment operations will work for all of our client mandates. And they approve that in a public meeting after it's been first reviewed in another public meeting by an advisory council made up of professional or of people with institutional fiduciary experience. So with all of that in place, starting in about 1974 with a 40% funded ratio, the Florida retirement system became fully funded in the late 90s, in part because of the dot-com boom and in part because of good, solid funding experience over that time. Then, given the success, its funded ratio continued going up, peaking at 118% in 2007. Around 2000, early 2000. So then the legislature said, well, gee, we may be funding this thing too well. Maybe what we need to do is deliberately suppress contributions for a period of time, save the member employers some contribution monies to meet other public priorities, and we'll take the funded level down to a little over 100%, level it off there, and we'll be fine there, and we'll remain fully funded forever, and we'll all live happily ever after. Well, the problem was that plan was interrupted by a little thing known as the Great Financial Crisis in 2008, when, first of all, over a period of 10 years, member employers were saved $6 to $10 billion in contributions, and the funding ratio ticked down a little bit. Then along came the Great Financial Crisis, and the fund went from a funding level of 108% to about 87% in a matter of months. And we have hovered at around that level since then. In large part, the investment returns have been fine and the benefits have not changed. In fact, we did benefit reform effective July 1 of 2014 that reduced benefit liabilities long term. But for the 3 years immediately following the financial crisis, Florida's budget, like most state budgets, was in extremis, which is to say short of money. And the legislature fully funded the normal cost, but did not fully fund the contribution to the newly created unfunded liability. Those underfundings were several billions of dollars and have contributed directly to our inability to get back to 100%, which I would still like to see us do. So I think the key thing is, number one, yes, you can effectively centralize investment operations. Number two, you can and should manage money internally. It will save you a lot of money doing so. Number three, for the most part, passive investment is a good thing, but there are definitely parts of the market where I don't think passive investment is a solution. I think Bob Maynard used the word niches. I think that's exactly right. If you're talking about domestic equities, for example, United States small cap or micro cap stocks would be areas where active management pays. If you stay in the equity class and you get outside the U.S., and you're talking about emerging markets or developed non-U.S. markets, active management tends to pay there. And lastly, I would say in the private market classes, private equity, venture capital, and real estate, I would say it's the only way to go. We have a very unusual real estate program where we manage about 60% of that asset class in-house, and it's a $14 billion real estate portfolio, so it's a serious one. Our results over long, long periods are among the very best in the industry because of two things. Number one, by managing assets ourselves, we don't have the false time frames that go with partnerships. Partnerships are commonly 8 to 12-year vehicles that are created, they invest money, then they sell assets to realize profits, and they distribute the capital to the limited partners, and the partnership dissolves and they form another one. The problem with that is if the timing of the fund creates an investment period such that it's not a great time to put money to work, no matter how good the managers are, there will be a vintage issue with the returns available on that fund. The other factor is on the backside. When it comes time to wind the fund up and sell the assets, if the sale environment is not conducive to selling at advantageous prices, then you suffer the consequences as an investor. The last point would be that there's some assets. I mean, think about Warren Buffett's example of the best business you can possibly have. The only toll bridge across a body of water where you own the bridge and get to set the tolls. If you have an asset like that that's perfectly located with very little competition, you want to hold it for your entire life and just increase the rents periodically and maintain the quality of the physical asset. You don't ever want to sell it. And if you're in a partnership, you don't have that option. So then the last part, of course, would be by doing this ourselves, we avoid an awful lot of costs in fees that would otherwise be paid in management fees and carried interest. I'll make one other point on the private asset side, and that is in private equity. I listened to the presentation you had earlier this morning from the gentleman from Oxford, and I must say I was kind of surprised at his conclusions from the standpoint that we have a very large private equity portfolio, and for 1, 3, 5, 10, and 20-year periods, net of all costs, it's our most profitable investment area. So I would challenge the notion that private equity is all fees and no benefit. I think net of all those costs, investors can do very well. So I'm gonna stop there and see if I can answer any questions for you.
Okay, yes. So thank you very much. And as you have commented, your systems, your funds are in far different circumstance than Pennsylvania. I just go back and tell you some things that we've done. In 2010, we did have plan design change in Pennsylvania. And as Commissioner Gallagher has mentioned a number of times, the fact that we were underfunding these two systems, and since 2010, we've been very fastidious about increasing contributions to the point that we were very close to the ARC. But beginning in 2019, we've got a hybrid design that is going to be 1/2 defined contribution and 1/2 defined benefit for new people coming in. We've got some risk sharing that's involved in that new plan design. We've got we've tried to address some of the unfunded benefits that take place in the form of non-compensated or non-contemplated overtime that we end up paying with under our classic defined benefit system. So we've done some work in that area, and like I said, we've worked very hard to make sure that we're getting to the point that we're paying our ARC. I'll just ask this question, and I think somebody said 13% of payroll. What is your contribution rates in your three systems?
Well, we really only have two systems. We have a defined benefit and a defined contribution system. And I think the contribution for employees is 3%, and the contribution for employers is 3% in the DC, and I guess they do a blended rate, so it's a little bit higher, but I think our overall contributions are in the 10-ish ballpark. So based on what I know about the contribution levels in other states, Florida's are substantially below most.
Great. How about Wisconsin?
We're right at about 13%, and it's shared equally 50% from the employers and 50% for the employees. It's been between 12 and 14% over the past decade, and it might be maybe actually 13.5 right now. It changes just slightly every year, but within that range. As of 2010, though, it's been shared equally. So previous to 2010, the employer picked up 100% of the cost of it. And then in 2010, that switched to an equal share of both employer and employee, except for a few special classes.
And you mentioned at one point in time you were 87% funded in Florida. What was your dip at your low level? Where were you at funding percentage?
The lowest, well, the very lowest back at creation of the fund, it would have been down in the 40s, 44, 45, something like that.
So you climbed your way out of a deep hole. I can tell you this, that Pennsylvania's contribution right now in both systems is north of 30%. So we've got
Holy cow.
Yeah, holy cow. So,
Wow.
This commission has been, convened for some real reasons, and a lot of it is the pain that our local school districts are suffering, as well as the Commonwealth in funding other much-needed government requirements. So as we take a look at fees and returns, our work is all the more important as a result of our underfunding status and our contribution limit at this point in time. So I will turn questions over to our Vice Chairman.
Thank you all. Very interesting testimony. As the Chairman indicated, we are envious of your funding status, although, as the Chairman indicated, Commissioner Gallagher indicated, it's a credit to our political leadership. The last 2 years, our state has made the arc, even at those levels, although there were many, many years where it did not, which have created some clear and huge problems. But I thought I heard in what each of you said that somehow the consolidation, and in Wisconsin and Florida's case, not Idaho, that somehow the consolidation was connected to a new determination to appropriately fund your systems with the ARC. Did I hear that in your histories, or am I imagining that?
You heard it in mine. This is Ash Williams in Florida.
I did. Okay, so that was the consolidation was part of an overall determination to get to a better place, which included making the required contribution.
Correct.
And when there was 3 main plans in Wisconsin that consolidated in the 80s, and what they have been doing over the years is working with their constituent groups to make those plan designs look similar and more similar, so that the benefit would, once there was actually the merger, that those plans would look very similar and then go to a single plan. For any unfunded liability that existed at that time, it was crystallized and then paid down appropriately by the employers. I do not know what the extent of that underfunded with. It wasn't very substantial, but it was crystallized and then as a requirement going forward to be paid off over time.
Great. Thank you.
Commissioner Gallagher.
Yes, thank you, Mr. Chair. I think that there's so much to be learned from the systems that we have on the line right now about how to take this moment and apply some best practices, specifically when it comes to governance, whether it's for the whole organization or the investment office itself. I recently learned that Florida went through the process of bringing performance pay into the shop again, or I don't know if it was ever there to begin with, but Pennsylvania does not have that. I'm not advocating for it, but what I'd like to elucidate this commission as well as myself on is what the value for money is to have a performance-based pay investment office, and also if there are ways to educate the public why in fact a public entity might have performance pay. It's a private sector idea. Can it be applied to the public sector too? What lessons were learned in that process?
Would you like me to take that as an opener?
Yes, please.
Okay. Yes, I think, first of all, it's exactly the right question. I'm very, very sensitive to how difficult it is to provide even remotely competitive compensation in a traditionally highly compensated field like investment management for public sector employees, particularly when the vast majority of public sector employees have rather modest compensation, and taxpayers generally, if you look at average family or individual incomes in most states compared to average incomes in the investment management industry, the contrast tends to be rather steep, rather severe. So in Florida, the way we approach that to gain understanding, buy-in, and to share the value proposition with all the constituencies and stakeholders of the Florida retirement system was we held a series of public meetings, and you'll think I'm exaggerating, I'm actually not, over a period of 6 years developing our compensation scheme that we have now had fully operational for 3 years. And what we did was take great pains to ensure that everybody understood exactly what was going on. Very high degree of transparency, very high degree of structural alignment in the interests of the taxpayer, the beneficiary, the senior part of the governance structure, and the investment professionals working at the state board. And we were able to establish very clear documentation using a third-party fiduciary external compensation consulting firm, Mercer, to advise us on that, get us comparable data, et cetera. And the other thing we did that I think was smart in retrospect was we never said, let's make our objective to pay the same as Wall Street. That obviously would be a foolish and unfulfillable goal. And so we said, why don't we compare ourselves to our brethren in public pension land, other very large public pension funds, and compare our compensation to theirs and see where we stack up. And as I said, we started this back around, it would have been around 2011 or 12, something like that. We started working on this 2010. And we found in those days, even though Florida was bigger than all but 3 or 4 other funds around the country, and we had a very complicated asset mix covering everything from venture capital to frontier markets to U.S. Treasuries, and we managed a very substantial amount of money in-house, our pay was in the bottom of the 4th quartile nationally. So we built the argument that, look, there's a terrific value equation here. Our performance has been good. It compares well with our private sector managers. And to the extent we can do it for less here, it's worth retaining the talent, but we've had high turnover. We've got a lot of vacancies. It's unrealistic to think we can sustain this. And so we were able to benchmark against other public funds. We agreed to a target of being at the 50th percentile of the 10 largest funds or the 75th percentile of all public funds in the U.S., given what we do. And our trustees agreed that in a public meeting after it had been reviewed in multiple public meetings of our Investment Advisory Council. And slowly but surely, we gained acceptance of the concept. And I'm delighted to say, and this is very counterintuitive, the only press this initiative has ever received has been positive, because any reporter who sat through the proceedings and actually saw the numbers said, good Lord, this is one of the highest returns on investment we could possibly have. And I think one of the things that sealed it was one of the elements of compensation that makes it competitive is one that I don't believe Pennsylvania has, which is we have base compensation for each position that's mapped and checked every 3 years against the marketplace. And I think Pennsylvania does that. But then we also created a new level of incentive compensation that's based on investment performance and has, depending on the level of the individual, the seniority of the individual, it will either be primarily quantitatively driven by investment performance if they're senior enough to really drive investment performance, or if they're junior enough and their responsibilities are more broad, it will be primarily subjective at the discretion of that individual's supervisor. But if our entire compensation system, based on the performance of the fund, based on clean audits, based on no compliance exceptions, et cetera, every single thing lines up perfectly, the way it works out is the component of the total gain in the fund above benchmark that would be distributed to our employees at the maximum payout levels that are fixed, they're not infinite, for our incentive scheme would be 30 basis points of that gain. So 31 hundredths. So the way I crystallized that would be to say to the casual observer the following. If I propose to you that you give me a quarter and a nickel, and I will hand you a $100 bill, how does that sound to you? You'd probably be willing to do that, wouldn't you? And everybody says yes. And the answer is that's exactly what the scheme of ours does. And if that results in a portfolio manager of an asset class where they might be managing $70 or $75 billion on their own desks, like our global equity unit does, and they outperform by 50 or 100 basis points in a year, the portion of that would equal the maximum incentive compensation they could earn is literally a drop in the bucket compared to the gain they produce. And it pays out over multiple years, so it has a retention capability. There is a provision that says if there's any risk violation, any compliance violation, any disciplinary violation, you're barred from getting incentive. And if you've earned 2 years worth of incentive, you've collected the first year and the second year is in its deferral period, and you commit some kind of an infraction during that period, too bad. You lost what was deferred for you. So it's been very effective. We're in our third full year of it. As I said, it has not been an issue. It has not been controversial. I've been somewhat amazed by that. And I'll tell you with absolute honesty, I'm relieved because it's worked really well and it's served its purposes and our performance has been good and we've been able to hire terrific people and keep them.
Okay. Thank you very much. With that, I will make the same request that I made to other testifiers. As we absorb the information, we appreciate your expertise and your willingness to testify. As we move forward and absorb the information, if the commission or its consultant would like to get in touch with you, we would greatly appreciate your open lines of communication as we continue to work through our process. So thank you very much for your testimony, and we will likely be in touch at some point in time soon.
Thank you.
Thank you.
Okay, we're moving along and trying to make up a little bit of time, but we do need to take a 5-minute break right now. People that are working with us need a chance to get up and stretch. So with that, we'd like to convene in 5 minutes. Thank you.